I take you straight to the S&P, flirting dangerously with 2,900. New records on the Nasdaq. It's in the GTV library. But my question to you is this. The data's rolling over. I've put the city economic surprises for the US versus global economic surprises. We are on the wilt, sir. Would you be long the SPOO? Do you want to join in the record rally?
I think, it's a little bit too early to be talking about holding cash or withdrawing from the market. The torrent of the good news is still very good. The corporate earnings growth, which is, what is holding the market and driving, is still incredibly good. And I think that we have another quarter or two of fairly good earnings growth to come. I think it is next year that the earnings growth is going to begin to taper down. So in that sense, I think that the market is not going to be given a chance to correct. We also have expectations that perhaps the Fed is going to reduce its interest rate expectation rises for next year. There's already discussion on that taking place about whether the flattening of the yield curve is going to force the Fed's hand to guide the market down in terms of the interest rate rises next year, which were around 3 back towards perhaps 1. So I think those are the things that are supporting the overall market. But I think the thing to look is within the market, the leadership has continued to narrow. The larger mega caps are holding the market up. If you look under the bonnet, more than half the S&P 500 stocks are actually down year to date. So I think you need to be very careful where you are positioned within the market. And we think it's time now gradually to market towards more stable companies, more companies with certain earnings growth expectations that have been left behind in this very high risk mode that we are in.
It's the ones that have been left behind. So I'm guessing the answer to my next question is going to be no. Is it the time run to get back into emerging markets then, Ashok? Because what you said about the Fed would play positively for risk assets. It would play positively for emerging markets, perhaps.
Yeah, I think the main reason that the emerging markets have been sold off aggressively this year is really to do with the raising interest rates in the US and, of course, the reduction of the liquidity. And I don't see anything that changes in the next couple of quarters in that direction. We've got more interest rate rises, 2 more to come this year. We've got continued reduction of the Fed balance sheet, rising to $50 billion per month. So, in other words, the pain that has been exerted on the emerging markets is probably going to intensify in the next 2 quarters. So yes, there are values to be had, but I think that we're going to continue to see another sell-off in the emerging market assets. We had for a number of years, a search for yield, and the emerging market assets, especially the local currency bond markets and so on, have been very big beneficiaries of those flows. And those flows are only beginning to reverse, and there's a lot more reversal to take place.